Good morning, everyone. Thank you for tuning in to this webinar. I'm Lin Sin, analyst covering the consumer and healthcare sector. Although yesterday was, sorry, can you hear me? Thank you. Okay, sorry, where was I? Okay. Although yesterday was Father's Day, but today we will be talking about mothers. So we are going to discuss in depth into this company called Singapore ONG Limited, which we have initiated our coverage on last week. So just to give you a snapshot on how the company has been performing. So it closed at 82 cents last week Friday, and we have initiated with a buy call at a target price of $1. Okay. Just a brief introduction to those who are not familiar of SOG. So SOG is actually a leading group of specialist medical practitioners in women's healthcare. They specialize in obstetrics, gynecology, gynecological and breast cancer, as well as dermatology and skincare. So they have just started their dermatology business in January this year. They currently has 5 ONG specialists, 3 cancer specialists, and 1 skin specialist. 1 more ONG specialist who will be starting in July. They are based in solely in Singapore and operates out from 10 clinics in 6 different locations, mainly in the central and east region of Singapore. ONG services is the main revenue driver for SOG as of last year, as well as for from its previous years, because it has just incorporated their cancer-related services back in end of 2014. So as you can see that the revenue contribution from cancer-related services actually grew from 1% to 9% to its top line as of last year. And we are expecting it to continue grow moving forward to this year. And due to its ONG's focused business nature, its customer base comprises mainly individual patients. As you know that obstetrics services are not usually covered by insurance, hence they don't have much corporate clients, but the management have indicated that they are moving forward to gain more corporate accounts, which we will discuss a little bit more later. The company was listed on the Catalyst board on 4th of June last year with an offer price of 25 cents. So to give you a background on why are we positive on these stocks. So coming from a top-down perspective. So firstly, because of this steady population growth, which actually provides a stable patient base for SOG. As of June last year, Singapore's population is at about 5.5 million, and according to the white paper published by Singapore government in 2013, the Singapore population is projected to grow to 5.8 to 6 million by 2020 if all conditions remains status quo. With that, I'm referring to the fertility rate, the macro environment, and social norms, things like that. So, and by 2013, the Singapore population is projected to grow to 6.5 to 6.9 million. So this actually implies that the 15-year CAGR for Singapore population growth rate to be at around 1.1% to 1.5%. And looking at the past 10 years record, the Singapore population has been growing above 1%, hovering at about 1% in last year. So giving you a longer track record of gauge of how Singapore's total live birth trends has been. So because of the predominantly ethnic Chinese demography in Singapore, obstetrics services are actually seasonally higher in the year of Dragon, as it's being regarded as the most auspicious of the almanac. As you can see from here, in 1988, 2000, 2012, it actually peaked. So when we mention Singapore population growth, actually it's population growth rate in any in any countries, we will be looking into a few vital rates, namely the gross reproduction rate, net production rate, fertility rate, and the crude birth rate. So these four actually gives you an indication of how the Singapore population growth has been trending. So the reproduction rate actually gives you a feel of the average number of doctors, meaning that how Singapore population is going to repopulate itself. And we have actually given you a trend of for the past 10 years. So for all these four indicators, it has been remained relatively stable. And as we compared against the past 10 years ago in 2005 versus 2014, and we also compared it against our developed country peers, being US and Japan, and regional peers as well, being China, Indonesia, Malaysia, and Thailand. You can see from here, Singapore's population growth is actually quite relatively high in both years compared to its peers, regionally as well as the developed countryside. So in 2005, we have seen such a high growth rate, probably mainly because of the immigration policy taken by Singapore government, and it has actually dropped down to as comparable with Indonesia as well as Malaysia. This is actually backed up by the Singapore fertility rate, although that it has been quite relatively high here, but it's actually relatively low compared to its peers in terms of fertility rate. So what we are looking forward to is that it might be mirroring Japan's case, where Japan government is actually spending a lot and rolling out policies to boost their fertility rate. So will Singapore be seeing another following in Japan's footstep, where we might be seeing a boost or a jump in fertility rate in Singapore? Secondly, the change in social norms, which would increase demand for ONG services. As you know that age is actually the single most significant factor that affects a woman's fertility. A woman's prime age, considered as her most fertile period, will start from the age of 20 and range all the way to age of 34. So this is actually considered as the most fertile range. But as you can see that there's a shift where because of aging population and the shrinking labor supply in Singapore, women are starting to concentrate more on their careers in their early age and deferring their marriage, and that actually leads to later motherhood and later conception. So you can see from the chart here, in 2005, women are getting married at the age of 27, and that actually ticks up to age 28 in 2014. And from this chart itself, you can also see that there's a shift of the norms, where women are getting later and later for their first conception. So what does this have, what would this implicate the Singapore population growth? So if for women who are after the age of 35 years, this actually increase their risk of infertility. In addition, older mothers has higher risk of pregnancy and birth complications, and hence this would actually boost the demand for ONG, where women will seek for fertility advice or assistance, as well as there will be an increased demand for medical care for older mothers. Third, rising consumer and affluence within the region itself. So there's an increased health awareness within the region as together along with the rising spending power within the Southeast Asia region. This actually helps to support the demand for comprehensive and quality specialist healthcare services. So there are more and more people who actually prefer to seek quality healthcare services and especially from the private doctors, where they provide niche and specialist treatments. So from this chart itself, it's evident that there are more and more people who prefers to deliver in private sector hospitals, and is actually sustaining at above the 58% level of total live birth in Singapore. Fourth, the supportive government initiatives to increase birth rate. Knowing that there's an increasing cost of living in Singapore and there's growing needs, the government actually has provided various supports to help parents in the areas of delivery costs, as well as to further defray child raising costs. As you can see from these light blue lines here, it's actually trending upwards, indicating that government is actually spending more on social and family development. Fifth, there are positive market outlook for cancer services as well, because on the back of increasing growth of cancer notifications. Cancer actually affects all ages and social economic groups. And according to Ministry of Health Singapore, cancer is actually the #1 cause of death in Singapore. It accounts 29.4% of the total death in 2014. Hence, access to effective, quality and affordable cancer services are highly sought after. So zooming into the female population in Singapore residents, you can see that about 44% of female cancer patients actually suffers from female-related cancer, meaning that would include female breast cancer, corpus luteal, ovary, and cervix luteal. So all these actually add up to about 44%. With this, the breast cancer actually marks the highest, most frequent cancer in females in Singapore residents, and by that, there's a chance of 1 in 15 Singapore female residents who might suffer from the female breast cancer. However, as we look into the top 10 most frequent cancer deaths in females within the same period, you can see that 17.6% actually died due to breast cancer. And this gap actually indicates that early detection and treatment would help to, is actually essential, and SOG actually provides both services of detection and treatment. Six, is actually in tune with Asia Asia's burgeoning cosmetic and skincare industry, where you can see that dermatology markets actually has a high potential for growth. There's an increasing number of people suffering from skin disorders, and the most common conditions in Singapore are like acne, cold sores, hair and scalp problems, eczema, etc. So according to National Skin Center, eczema actually affects 1 out of 10 persons at some time in their life, and it could actually occur at any age. So with the combination of change of weather as well as deteriorating air quality, this could actually set the number of people diagnosed with skin issues to continue to increase. Also, there's an increasing awareness for aesthetic through social media, acceptance, and availability of treatments. So with all these favorable macro backdrops and trends in Singapore's demographic and social norms, so why SOG? Firstly, because of its growing market share. In 2015, SOG's market share actually, they actually registered about 4% of total live birth in Singapore. So that compared to, as mentioned earlier, the about 58% by private hospitals, this implies that there are huge room for SOG to grow. And for the 4-year periods between 2012 to 2015, SOG's number of deliveries grew at a CAGR of 9.5%. And their long-term goal is to reach 4.5K deliveries per annum. And they have reached 1,633 deliveries as of last year. So how are they going to increase their market share? Firstly, by increasing the number of clinics. Currently, they have they operate out of 10 clinics and 6 locations, and with the addition of their new O&G specialist recruit, who will be joining them by July, this will add another clinic and another location to the group at Mount Alvernia Hospital. So that will give a total of 11 clinics at 7 locations by July this year. Secondly, by expanding the number of specialties and choices. So they intend to hire more specialists, particularly in medical specialties it previously was unable to offer. So for example, they have actually recruited 2 cancer specialists by end of 2014 and 1 skin specialist by end of 2015. So by 2017, they intend to add another pillar of growth in children healthcare services. They may also offer ancillary goods and services to patients. They are not easily available in Singapore. For example, supplements or skincare creams that are their products from Dr. Joyce Lim's clinic. And these are actually proprietary products. Thirdly, they intend to expand its customer base by being able to offer some of these services out of Singapore. So as mentioned earlier, they intend to open up to more corporate clients by customizing and providing women's healthcare packages. And also they intend to open to overseas partnerships, and hence this will open up to more medical travelers. Next, we like SOG because of its diversification. which actually gives them the resiliency of their business. It actually started off their business with only 2 O&G specialists in 2011. And over the years, it has expanded the number of specialties and choices offered. So now they have breast and cancer-related services, as well as dermatology and skincare. So the first pillar, O&G, it forms a stable base for SOG's top line, although that it commands a lower margin with a net profit margin at about 30%, but is mainly driven by volume. The demand for obstetrics services depends very much on domestic demand because of the citizen issues, but this also implies that it has lesser risk of patient outflow to overseas, and also is unlikely to see an influx of foreigners seeking obstetric services in Singapore. So with that, we do not expect a huge jump in demand, but it should be relatively stable as per government's projection. The second pillar, breast and cancer related services. So this is actually the margin driver for the group. It commands a net profit margin at about 87%. It has a larger market base catering to both local and foreign patients. But because that it's a newly incorporated business to SOG, where it's only acquired by end of 2014 and has only turned profitable last year. Hence, it actually contributed about 9% to its top line at the moment. But we expect that this will continue to grow and continue to improve the group's margin moving from 2015. As for the third pillar, the dermatology and skincare business, we expect the group to be able to reap synergies of lateral integration between O&G and Dr. Joy's businesses. So skincare problems is actually very common during pregnancy. For example, having stretch marks. Hence, patients from the SOG clinics with skin problems can be referred to Dr. Joyce. Meanwhile, Dr. Joyce Lim's patients with hormonal, medical or surgical problems can also be referred to the SOG's panel of doctors. The fourth pillar being the pediatrics, and the management has guided that it should be kicking in by 2017, and they are seeking suitable recruits. This actually helps to lock in the period of its female patient base for additional 16 years by providing healthcare services to newborns, children, and adolescents up to the age of 16. The group aims to achieve 25% revenue contribution from each of these four pillars. So this is a snapshot of the company's business model. So for a female, the group actually currently service females from the age of 16, where they start their puberty stage, and all the way up to even beyond 75 years old. Sorry. At this point, at this point, when women started their puberty, O&G services and even for dermatologies and cancer-related services will be able to kick in, but cancer-related services would be more valued towards post age 75. And O&G services would be more significant when women has passed their prime age of age 30 and above. So more female patients will be seeking medical advice if they would like to. They will be seeking more advice regarding fertility. So by adding another pillar of growth on children healthcare, this will actually adds another 16 years lock-in period. So they are actually covering the whole life cycle of females. Thirdly, SOG actually has a very long and established track record where most of its medical clinics and specialist medical practitioners have a track record of more than 10 years in their respective field. And this actually helps them to be able to command for a higher premium for the services they rendered. Fourthly, their clinics are actually conveniently located, as most of their clinics are located within major hospitals and are easily accessible by public transport. They also provide flexibility for their patients to deliver their babies in any of the hospitals that they are accredited to perform deliveries at. So these are the few hospitals. Last but not least, we like the group because of their strong financials and a clean balance sheet. So these charts are actually self-explanatory, where you can see that on a 3-year CAGR basis, the top line and the bottom line are actually growing at a double-digit pace. And their net profit margin has actually maintained above 30%, even though that they have incorporated the cancer-related services in end of 2014 and end of 2015 for skincare. We believe that this is still sustainable because of the long track record in ONG field, as well as their very niche services in cancer-related and dermatology. The group is also in a net cash position of 24.2 million. This actually accounts for about 88% of its total assets. Its total liability, if we minus off its total liabilities, it actually has about 20 million war chest. This is actually sufficient for the capex of 5 to 6 new clinics without the company to raise any further capital. So how do we derive to our forecasted earnings? So we look into the main growth drivers, being their ONG services. So we predict that based on Singapore's government's white papers, there will be 1% growth in Singapore's total live birth, and private sector hospitals will continue to account for 60% of it. And we assume that SOG will be recruiting an additional ONG specialist each year for this year and also for the next year. Sorry, there's a missing F here. So ONG services will continue to underpin the group's top line, along with this increasing specialists. As for margin and cost, so the group, we expect that the gross margin is sustainable at 89% over the next 2 years, and the net margin to be sustainable at 31%. We actually take into account of the new ONG specialists they recruited and will be starting in July, and also we took into account of the new cancer-related specialists which started in May. Hence, there's a slight dip in net profit margin for this year. And as for next year, we took into account of the setup costs for their pediatrics pillar segment. Sorry. So there's hence we think that although that the cancer-related business from the 2 existing specialists has already turned profitable, we think that the new capex for the new recruits as well as the new segments will continue weigh on their net profit margins. Nevertheless, we think that it will still hover above 30%. Zooming into costs, employee costs is the largest operating cost, but the group has tried to maintain it to be below 40% of their total revenue. The second largest expenses would be their administrative expenses, and followed by their operating lease costs. And we think that there shouldn't be much changes as a percentage of their revenue, as the management is quite prudent in managing their costs. As for working capital cycle, we also assume that there will not be any change in terms of patients' payment structure, the group's inventory management, as well as credit terms with its suppliers and leasers. So it should be reverting back to 2014 structure instead. As for dividend policy, the company has no fixed dividend policies, but it has a 90% payout target, and they have made their first dividend last year, which implies a 76% payout ratio. Given that they are going to incur quite a significant capex for these 2 years, we think, and they are going to fund it internally, we think that they should be able to pay out at least 80% of their earnings, and the management also has indicated they would move towards their targeted 90% payout ratio. So after deriving our earnings, we value the company based on a P multiples valuation method. So we compared against its Singapore peers. We applied a 20% discount to its peers due to a liquidity risk as well as a smaller operation scale, and this gives us a derived P of 28 times forward P ratio. So this is actually quite close to its historical P ratio at 28.6 times. So we have with this we initiate coverage on SOG with a buy rating with a target price of $1 based on an estimated 3.55 cents for 2016 EPS. So this chart for you to get a feel of the historical PE and the 1 year historical performances where Singapore actually SOG actually outperformed the other benchmark indices. So just to recap, what would be the near-term catalyst for this company? Firstly, it would be coming from its previous recruitment drive, and the effect should be kicking in by this year, starting this year. So we will be expecting a full year contribution from the newly acquired Dr. Joyce Lim's dermatology and aesthetic businesses, which they acquired in December last year. And we will be expecting a new revenue stream coming from the new breast surgeon who joined in May this year, and a new O&G specialist who are expected to join in July 2016. So with this new O&G specialist coming in, we will be seeing a new location in Mount Alvernia Medical Center. So this would brings the total clinics to 11 clinics in 7 locations. We also expect that the group will continue to increase its suburban reach. Currently, the group only has 1 suburban clinics in Cassia Street, and in the longer term wise, they would like to expand regionally as well, where they have intention to set up overseas sales representative office. This would help to diversify their client base as well. And thirdly, there will be new pillars of growth coming in by 2017, and also we are expecting some synergies coming from SOG and Dr. Joyce Lim. They are actually currently working together to develop a stretch mark cream with Dr. Joyce Lim, and also they might be looking forward to develop other formulation possibilities, which include a cream for pigmentation, which would be safe for use during pregnancy. So just to touch on investment risk, firstly will be on competition, coming from domestically as well as regionally, especially from Malaysia's side. Lease renewal, as the company actually adopts a asset-light model, all their clinics are actually rented, but two of their clinics are actually rented from their own specialists, namely Dr. Heng as well as Dr. Bear. So the risk for lease renewal or unable to obtain at a cost-effective rental rates would be of a lesser extent in that sense. The group also is currently facing some key personnel risks, as the group previously is mainly consists of O&G services, so it's heavily dependent on the O&G specialists, and now with the addition of cancer-related segment as well as the dermatological segment, the key personnel risks should be able to diversify diversify somewhat. Dilution in shareholders' equity and shareholdings. With the new recruitments, the SOG, the group actually, the group usually would funds it by issuing new shares. So there might be risks where shareholders' value might be diluted. Other risks would include execution risks in their expansion plan, competition laws and regulations, which may subject the group to antitrust and merger control, liquidity risks, for the group is being catalyst listed, any change of regulations and licensing requirements, because the group is actually governed by Singapore medical regulations. And ironically, outbreaks, occurrences of epidemics and pandemics may actually drive down demand. For example, the recent Zika virus. So just to conclude my presentation for today, we are positive on the stocks because we think that there will be a further upside stemming from its expansion plan as well as its growing customer base. Just to recap, we have a buy call on SOG with a target price of $1. Yep. So this ends my presentation for today. And now we'll open the floor to any questions. Okay. So there's some questions regarding their current corporate clients, who are their current corporate clients, what's the current profit contribution of aesthetic. So regarding their current corporate clients, they are actually they are usually usually these are from their cancer related business segment. They because insurance usually don't cover obstetric services, so they don't really have much corporate clients at the moment. But if there's any significant significant changes, or they have taken significant corporate clients, we will be updating on that. But there's none as of the moment. The current PE as of last Friday is at about 30.7 times. That is based on 2015's earnings. How long are the doctors committed to being in the company after buyout? Usually it would be of a 5-year service agreement. What kind of non-competitive clauses should they leave the system? They are only binded to non-competitive clauses within their years of within the contracts, the 5 years services in their service agreement. So after the 5 years agreement, should they leave the company? They're actually not binded to these non-compete clauses. As for just to recap on what I've mentioned earlier on the corporate clients account, uh, I've mentioned that currently they mainly comprises of individual clients because of their ONG natures, because they have just incorporated their cancer-related business segment. Hence, the component for their corporate clients is not that significant, and they have intention of growing their corporate clients. Yes, it has. Okay, there's a question on has it been 5 years yet since it started? Has there been any attrition? Yes, it has. Sorry, it hasn't reached the 5 years mark yet, but there are two that are coming into the 5 years uh, service agreement, namely Dr. Bay as well. Wait. Oh, sorry. Dr. Oh, sorry. Sorry, let me rephrase that. Okay. For the 5 years, it started from Dr. Natalie Chua, because when they first incorporated, it was only Dr. Lee and Dr. Heng. So these are founders. And when it started with Dr. Natalie Chua, she was being employed in 2013. So by 2018, we'll be seeing the first time that a specialist has ended their service agreement. So as of now, we have not seen any, and there hasn't been any attrition yet. There's a question on do we know the largest revenue contributors and when are their contracts up? So one of the key contributors would be Dr. Heng Dong Lan. So she's actually one of the founders. So we don't think that she's likely to leave because the group is still on an expanding stage, and she's actually the one of the she's actually the chairman of the board at the moment, and she's serving her 2 years term starting from this year. And the next key personalities would be Dr. Joyce Lim, but she has just recently onboarded SOG company, so it's also unlikely that we'll see a significant drop in the revenue at the in near term. Okay, there's a concern on the termination of agreements done in the past in October 2015. 2015. So this termination is actually referring to Dr. Bay's surgical company. So this surgical subsidiary provides Dr. Bay for the facility to conduct surgery in the past. So after they have IPO'd, and as indicated in their IPO prospectus, they have terminated the agreement, and now they are currently using the surgery facilities in the hospitals they practice in. So it has nothing to do with the service agreement with any of the specialists. For the lease agreements, there's some queries whether that the doctor owns the lease from the hospital or medical center. Okay, actually for the lease agreements, right, there are only two leases that are owned by the doctor. One is at the Kasia Street, and the other one would be on the Dr. Bay's Dr. Bay's medical clinic. So these two branches would actually lease. These two branches lease are actually owned by the doctors. The current PE is at 30 times. Yes, people has actually been priced in the growth for its cancer-related clinics, but in the near term, the skincare business segment would actually contribute about 30% if given that the 2015 revenues are to maintain. So when this full year contribution from dermatology segments kick in by end of this year, this will actually normalizes the P down to about 28. Okay, for the rental leases, okay, just to be sure that they only own two of they lease. Okay, this is actually considered as an interested party transaction where there are two leases they leased from the two directors himself, and as for others, it's actually leased from the hospitals. So in that sense, they do not own or okay the majority of the leases are not owned by the group itself. It's mentioned as a risk because that one being that although knowing that within the near term they are they are actually revising their renewing their contract leases in this year and next year. So for those they are leasing from the hospitals, they will be receiving a new rental rates. But management guided that either it is going to stay constant or there might be slight downward revision given that given the cloudy real estate uh, given the cloudy property market at the moment. So probably at the in near term, we might not be seeing that there will be an increase in rental costs coming from the existing clinic. But since they are expanding their clinics, uh, we are not sure whether that they are going to get new locations at favorable rental rates. So that's the one of the risks. Okay. Since there's no more questions, we shall end the webinar. Thank you for tuning in and hope to see you again next week. Thank you.